Hey traders, Jason here from Levitt Brothers. So let's talk about the state of the market. It's been a couple weeks. I'm going to show you the indexes, the SP 500, monthly, weekly, daily, and then I'm going to look at a couple of breath readings to get a sense of what's going on beneath the surface. All right, let's get into it. All right, so here is the S&P monthly chart with the 10 and the 50-day moving average, or not day, month. Support from the 50 there. This is a little bit sloppy after COVID. Got support there. 10, it rides the 10 in shorter term trends. It rides the 50 in longer term trends. Overall, the structure of this chart looks very good. You got a big rally here, came down, tested the 50, moved up. Resistance level here at about 4,100, took that out, moved up to 4,600, which was the highs over here, came down and tested 4,100 again, that resistance level from before, and then we rallied up to a new high. Everything looks good here. The structure of this chart looks good. The trend is up. The market is acting orderly. Yeah, you can zoom in very close and you could question things, but overall, you cannot argue that the market is anything but strong and healthy and trending up right now. Could it drop back and test the 10 again? Sure. Could it drop back and test this resistance, this former resistance level at 4,600, sure. But overall, the trend is up, and we don't know how far it will go. We don't know how long it will last. Our job is to be long and just manage those positions and not try and outguess or be smarter than the market. Just go with the flow and don't question things. All right, here is the weekly chart. Absolutely beautiful cup and handle pattern forming. Got a big rally off the 2020 low. Rallies up from 2,200 up to 4,800. Big cup and handle pattern plays out over the course of 2 years. Takes out resistance here at 4,600. Comes up here and pauses for a few weeks at 4,800. Then takes that out. Everything looks good here. This cup and handle pattern is resolving to the upside. Could it drop back and test the 8 EMA, which is this light blue line here? Sure, it could do that. Could it actually drop and test the 21, which is right over here? It could do that too. The 21 tends to be pretty good support and a level that it consistently retraces to. If we want to look at the 8 and the 21 here, here's the over on the left side here. There's the 21, support from the 21 here, support from the 21 there. A little bit sloppy support there, sloppy support there. So that the index tends to, and then here's the blue line, which is the 8. I'm going to draw it so it's really clear. So in an uptrend, it tends to ride the 8 and then occasionally dip down and touch the 21. Then it rides the 8, dips down and touches the 21. So, could we get, eventually we'll get a pullback to the 8 here. And then it'll keep riding it, and eventually we'll get a pullback to the 21, and that'll be a great buying opportunity, not a reason to panic. So everything looks fantastic here. Let's look at the daily chart with a couple indicators. So we'll review what has played out over the last couple months. We had divergences form. We had higher high here. Let me do a better line there. Higher high here. We had negative divergence, a little bit of a negative divergence there, not a big one. Then we had MACD crosses down, stochastic crosses down, RSI trend line right there breaks to the downside. So we got a couple things that all point towards a likely correction. We didn't get a huge move down, just basically a week and 100 points. S&P moved down, tested the 21, moved back up, came back down, and moved back up again. Let me draw some more lines here. So as it was consolidating, it was like, working off these overbought levels with the passage of time. We have another trend line could be drawn here. I didn't draw that very well. Let me see if I can draw that again. Oh, that's not what I want. So trend line there. So then what we have here is we have a trend line break here. MACD crosses back here along with resistance at 4,800, and obviously it takes out that. So when you take out that, when that crosses back up, when this crosses back up and trend line break there, everything is acting very orderly. Trend is up. Everything is strong. Everything's going well. No qualms about anything. Are we going to eventually come down to the orange line here and test the 21? Absolutely, it's going to happen. Whether we move sideways and the 21 comes up and meets it, or whether it corrects down, it's going to happen. But for now, again, our job is to just turn your brain off, go with the flow of the market, and not question things, not try and be smarter than the market, okay? More money is lost by people not participating in rallies than actual losses themselves. All right, let's look under the surface and get a sense for what the participation is right now. All right, so here's the SP 500 with the 10, 20, and 50-day moving averages of the NYSE advanced decline line. So we'll first look at the bottom, which is the 50. Looks like we got a negative divergence in place here because we got a lower high while the market is obviously moving up. I'm not overly concerned. So if today is right here, 50 days ago is about over here. So if the indicator is moving down a little bit or not being able to match a previous high, it just means that the data points from these days, which replaced the days from 50 days prior, it just means that these data points are a little bit better than these data points. But so what? I mean, it's not that big a deal. You tend to get huge prints off of a low, which is what happens here. So the fact that these over here are less than these over here are not a concern. That's why we have a divergence here. But again, I'm not really overly concerned. If I had a concern, it would be more with the 20-day moving average, which is the middle one here. It's a very obvious divergence forming here. This is probably my favorite time frame as far as looking back at indicators, because shorter indicators, maybe there's too much noise. Longer term indicators, often not that helpful because they're too long term. 20 days is a happy place for me. So it's a little bit concerning that the market is just like up, up, up. There's a heck of a lot more up days than down days. Advancers should be able to beat decliners day after day after day, and yet over the last 20 days, as you can see, decliners and advancers are approximately equal. The current print is just 48. 48 with an indicator that could rotate from like negative 500 to plus 500 or 600. It's barely above zero. So it just tells you that even though over here the market's been steadily moving up, or at least it's been steadily moving up the last 2 weeks, over the last 20 days, advancers and decliners have pretty much been equal. So there's a little bit of a concern that we're not really getting great participation. Then with the 10, yes, there's a divergence forming. I'd like to see prints just kind of in here. Just give me some steady prints up and down within there with an occasional dip to zero or even below zero. Okay, this dip here, perfectly acceptable for a strong market. Okay, you get dips below zero, it's perfectly fine. The market doesn't always have to be doing fantastic. Now I want a recovery. Okay, now I'd like to see a recovery without paying too much attention to the high here. Just want a recovery up to like 500, and then like give me some steady prints in there. Give me some oscillations above zero. Give me some indication that the market is steadily doing well as opposed to being slightly held back. Next up, so here is SP 500 up top versus the Russell 3000 stocks above their 5-day moving average. Okay, so we had a breakdown. We had a very obvious divergence, over here. With the market, doing fairly, obviously moved up, consolidated, but like less and less stocks were above their 5-day moving average. Even over in here, where the market was like right there at its high, and yet you had, less than 40% of stocks under above their 5-day moving average. So there definitely was a lack of participation. We got like a 2-day dip right there, and then it's been off to the races. The market's just up almost every day. This indicator has recovered. We got 280% prints here. So it's like the market worked off the oversold. It worked off these relatively poor prints with the passage of time. So going forward, what I like to see is this. I like to see oscillations that stay mostly above 40%. That's a pretty good line in the sand. Here's the 40% line. In a downtrend, you get prints below that to 20%. In an uptrend, you tend to stay above 40%. That's what I like to see. Okay, so at some point in time, we'll get a little bit of a pullback here, and I'd like to see this 40% level hold. All right, here is Russell 3000 stocks above their 20-day moving average, so a little bit better time frame as far as I'm concerned. So market was moving up and up and up. More and more stocks were trading above the 20-day moving average, and then we got a major divergence. I pointed this out in the last video where the market was near its high, but yet many less stocks were printing were above the 20-day moving average. Okay, not very encouraging. All that happened was the market dipped twice and then has been off to the races. It's a little odd because you don't usually get prints all the way down to 20% unless you're in a downtrend, which was the case in September, October, and August and such. So typically you don't get that. Typically you get, in an uptrend, you get a floor here at 40% where you get, it's pretty normal to get oscillations, down to 40%, up to 40%. That's perfectly normal. That's welcome. All these drops down to 40% are buying opportunities. But when you drop below 40%, that tells you the market's changing, and you got to be a little bit more careful that the move down is going to last a little bit longer. So it's a little concerning. We got to print down here at 20%. Going forward, same as the last chart, we obviously have a divergence forming where the market is up and up and up near all-time highs, and yet the number of stocks, the percentage of stocks above the 20-day moving average is only in the mid 60% range. So that's a little bit of a concern. And so when the market dips, it'll soften, it'll move sideways. We want 40% to hold. Okay, if 40% holds, then we're in great shape. If we drop below 40%, I consider that to be a little bit of a warning. Okay, so it's something to look out for. All right, here is the SP 500 up top. Down below is the number of stocks at a 5-day high low. Okay, number of stocks making a 5-day high versus number of stocks making a 5-day low. Okay, got a big breakdown over here. Okay, market corrected a little bit. Got a bunch of prints below zero as, bunch of prints over here below zero as the market kind of moved sideways to correct with time. Then we broke out and we got a 2,000 print. Okay, that's nice, but in the very near term, again, this is going up and up and up, but we have the number of stocks at a 5-day high versus a 5-day low has been declining from 2,000 down to 246. That's pretty bad. Okay, it's not a high bar to hit to get above its to be at a 5-day high, for the 5-day high low to move up. So in the near term, a little bit of a concern here that a lot of stocks are not able to keep up with the market. Okay, we know that Microsoft, Google, Meta, Amazon, Nvidia, they're all printing new highs almost day after day after day, and that's why the market over here is doing really well. But beneath the surface, there are many stocks that are not coming along for the ride, so it's a little bit of a concern. All right, one more chart here. Here's the SP 500 up top versus the 1-month high low. Okay, we have a similar situation. We had a breakdown over here. Okay, it's fine. Okay, all these prints are like really good. We get like steadily more highs than lows. Then we got a breakdown. Okay, goes below zero here, which is a little bit of a kind of odd because the market didn't really fall that much, and yet we had more decliners. We had more 20-day lows than 20-day highs. We got to drop all the way to minus 1,000, which tends to not happen unless over here you got downtrend. You get prints down at minus 1,000. So you don't really get low prints unless the market's trending down. But the market recovered up for the last 2 weeks, new highs almost day after day, and yet the number of stocks making a 1-month high versus a 1-month low is like barely above zero. So even though the market's doing this, thanks to the large cap tech stocks, there's not that many stocks that are doing the same thing. Okay, so overall, I like the market. The monthly chart looks great. The weekly chart looks great. Daily chart looks great. Okay, the indexes look great other than the small cap, other than the Russell 2000. Beneath the surface, there's a little bit of a lack of participation. There's, market's getting thin as the market moves up. It seems like it's being dragged higher by some of the large caps because the number of stocks above key moving averages and the number of stocks printing new highs on various look-back periods are not what you would assume would be the case given that the indexes have done so well. So I wouldn't be surprised. I like the market. Don't get me wrong. I'm long. I'm bullish. I think this is going to be a good year, at least looking out in the near term or intermediate term. Things can change, but I like the market this year. But I wouldn't be surprised if there's going to be some softness at some point in time simply because the participation rate just doesn't seem to be that great. All right. Hope you got something out of this. We'll see you next time.